Hello, this is Andrew Pancholi from the Market Timing Report, and I want to give you a little special presentation on harnessing gold. By the end of this video, you will know when gold is likely to move. You'll get a deep dive into our timing system. You'll also know the geometry behind gold, so whether you're a trader or an investor, you'll know where the key turning points or the key support and resistance levels are. Also, I'm going to introduce you to what the smart money is doing, and all this together will give you a significant edge in your trading and investing. First of all, I just have to give you the statutory disclaimer. Trading stocks and all other financial instruments involves risk, and past performance is no guarantee of future results, and we make no representation that anyone will or is likely to achieve similar results. This is purely an educational webinar. Take a look at this weekly chart of gold. At the bottom of this chart, you'll see a series of spikes. These are not volume, these are histograms that contain groups of cycles. And what you will see is where they peak, you'll see significant changes in trend in the gold market. And this is what we do at the Market Timing Report. We look at these spikes and we look to see where turns come in. Now the great news is these spikes are predictive. We know them in advance, and there's a very important turn coming up quite soon, and there's a few others. So at the end of this presentation, I'm going to give you some key dates, so stay with us. And here's the last spike, and you can see that nailed the exact top there before that significant sell-off. And people were very bullish on gold just going into that point there. So as I say, at the end of this presentation, just in a few short minutes time, I'm going to give you some significant turning point dates. But before then, I'm also going to build up the case, and let's see if we can work out what's going to happen on these dates. Let's take a look at the big picture on gold. This is the history of gold futures trading going all the way back to 1975. And using this low, this high and a subsequent low, we project this geometry. Now why is this useful? Well, first of all, this line therefore, when squared off with these lines, allowed us to predict this high here. And what we now find is that we're trading between these two lines here. So how do we use it? The bottom line is, if you're an investor and looking for the longer viewpoint, it's highly unlikely that gold is going to get above this line here, which is around about 2,200 to 2,400. Equally, if you're an investor and we see gold come down, then this level here is likely to provide a really significant level of support, around about 1,600 and rising. Now these lines then help us, especially this point. If we were to look at this to see if it holds, then that would give us a line from which we can balance our risk-reward ratios or create our risk-reward ratios with. In other words, we can put a stop below this and we know where to project our target to, and therefore calculate risk-reward ratios. So this is the very big picture. Now we can take this a stage further, and we do that by adding the internal lines. Now what does that show us? Basically, you can see how these lines here, well, more recently the market hit this line here, and that's why followers of our work in the Market Timing Report, the monthly publication that comes out, were forewarned about why gold would actually react. And you can see it hit there exactly. If we zoom in, and it came down very significantly. That was the big move down we saw a few weeks ago. So how do we use this further? Well, we can look for further validation all the way back here, and these half point lines, you can see that they've held the market significantly, and there was a bit of resistance there and support there as well. So that's where we're up against. That's why we've pulled back to this point in time. Using similar geometry now, we're looking at a continuous daily chart for gold, and this basically, this geometry has its origins back at the very end of November, using the high here and the low here. And you can see how this line, these lines were calculated from this point being an entry point, and this giving us a target, working pretty much perfectly. So we've now hit another entry point, and we're managing our risk using our stops trailing below there. So a pullback to here would give us a buying opportunity, but of course we want to make sure that these cycles here, here and here tie up with the proprietary timing cycles that come from the Market Timing Report. So this is very key information. We use this in conjunction with time cycles to get us the edge. But as long as this channel is maintained in this part upwards, then we can assume that the trend is up for the time being. However, the story doesn't stop there. If you want to learn more about how to use these techniques and how to set up risk-reward ratios, then we cover that all in our Market Timing Report trading course. Please see the website www.markettimingreport.com and look at the courses section. Now I want to introduce you to what the smart money is doing. This is based on the CFTC reports that are published every week that show what the positions are of all the significant traders and players. We take that data and put it into our market timing report professional traders platform, and we cover a whole series of instruments from equity indices to currencies to all the commodities. And let's take a look at gold. Well, first of all, there's some very interesting things. We can bring up a seasonality profile on gold. This is the average path of gold during the course of a year. Now, if you take a look, gold has a marked pattern. Basically, we do see that we see a bit of a surge, usually towards the back end of February in gold. What we see, by the way, let me explain in a bit more detail. The blue line is the average path of gold averaged out over the last 46 years since 1975. Remember that big chart we saw earlier on with the pitchfork? That went all the way back to 1975. Added on here is our own version of enhanced seasonality. And we look to see where the areas combine and match, so that where they both go up together or where they both come down together. And we look for those areas to see where the stronger opportunities lie. For example, here, the markets are a little bit out of sequence. They're not showing the same thing, so we wouldn't trade a seasonal profile there. But most importantly, coming up to today, let's see where we're at. So we're around about here. And this suggests we're slightly flat. Gold tends to make a low in June and then start moving up from there. And July can be slightly up or up, quite a bit up or flat to up. But then when we get to the beginning of August, we see a marked rise in gold, which tends to run up into the middle, back end, third week of September. Now I'm going to introduce some time cycles in a minute, but please bear this in mind and take a look at this point here. This is a point I'm particularly interested in. It's the roundabout the 6th of August, and we might be looking for something quite interesting then. Here is what the smart money is doing. Now let me explain what you're seeing to start with. First of all, this is the price of gold all the way back to 2008. This is our 6-month commercial traders index. Now, let me just explain very quickly. The CFTC demands that everybody reports their positions when they're trading above a certain size. Now, the commercials are people who hedge gold or produce it. They do not make money directly from the markets, so we can learn a lot about their behaviors. The non-commercials are shown further down. I'm not going to go into them in this, but just to say the non-commercials are things like the professional hedge funds, the smart money. And there is actually a third category called the non-reportables, and that's the small traders. And most of us fall under the small trader category. So if you're a big hedge fund, you'll be in the non-commercials, and you tend to be trend followers. And what happens with trend followers, just to explain it, trend followers tend to be wrong at extremes. So when a market turns, quite often the hedge funds are very, very long and they take a hit. Or when the market's making a bottom, they're very, very short as it reverses. And they're often caught the wrong way at extremes, but they are usually good in between. That's just a little bit of information for you. The commercials are the hedgers, and they make money by selling. So if the price of something goes up, they tend to sell more. And so this is the commercial short index. So as the price of gold was going up here, if we look at this line here, we can see that they were selling and selling and selling. And we created all these bits of data and we put them into an index. And what this index basically tells us is when this point gets up to the top here, around this top level, it tends to generate a buy signal. It's not a buy signal per se. We want to look at the technicals and the chart patterns to actually establish the trade, but it puts us on alert. So here we go. That there is showing that high there, and that showed us the low there. Similar situation here, high there and the low there. So we can see how this goes along, another one there and there. And this point here really heralded this big bull market that started back in 2018, 2019. Equally, we can derive opportunities for selling the market when we hit extremes at the bottom, but that's a slightly different kettle of fish. What I wanted to show you though is when we look at the amount, this here is the amount of commercial selling alone, and you can see that it's been dropping off of late as the market sort of made a high. They were selling and selling and selling till they got top dollar, until there's basically nothing left to sell, and they went up a bit more. And now here we are, we're coming down. But here's something really interesting. Take a look at this low here, and we saw this low here, and take a look at this point here. So these are down at the same figures, making lows there. And what we saw was that the level of commercial shorts was round about 160,000, 200,000, round about this area here. So this is an important level. So if we see this level come all the way down to here, then we know we're in for a potentially very big rally. If the market stays up this level though, the chances are the rally won't be quite so strong. There is a lot more data that can be, and information that can be gleaned just by looking at what the smart money does. But that's just a quick overview. So what I'm really trying to say is that right now the index is in the middle. It's suggesting if we get a rally, it might be a small rally. But remember, we looked at the seasonality and we saw a potential takeoff point around about the beginning of August. So if we get a big drop in here, we might be setting up for a strong rally. Now I want to introduce you to the mainstay of the market timing report. This is our profit finding oracle system. And what this is the histograms. We looked at them earlier, and here are these histograms below the chart, and these these show us big groups of cycles. It's not volume, it's a summation of cycles. And what do we see is that when these things peak, we tend to get highs or lows coming in the market. And most importantly, these are predictive, so we know when they're coming up in advance, and it's all based on a series of cycles coming together. So we can take these at different time sequences as well. We can look at them at a macro level on a monthly chart. And here's an example I want to show you. Way back in 2014, this is the entire history of the euro, which began trading in 1998. We saw this huge spike coming up. The market had been in an uptrend for well over a year, and we knew therefore that something was going to happen. And the chances are we often see a reversal when we see a big spike like that. So we were preparing for that. At the same time, in the same window or a similar window, we had a big weekly spike coming up, and they say these were known in advance. So now we're thinking there's a monthly cycle and a weekly cycle coming together. And if we put them together like this, there's the monthly cycle, there's the weekly cycle. The market was going up. We knew to expect some significant change in trend. But actually it got better than that, because we plotted the daily cycles and we found the monthly cycle was coming in, putting us on alert in this area. The weekly cycle was narrowing the window down to here, and the daily cycle was pretty much aligned. And that gave us the day there of the exact high on the euro. So this is an example of where all three cycle sets come together to enable us to identify a significant opportunity. Let's have a look at another example here. Here is the chart for crude oil. Back in 2008, we saw this cycle coming up. This massive move was there, and this weekly cycle came in, and that gave us this high here. And again, you can see another situation here as well. So this is how the cycle system works. And on this basis, let's bring it up to date. This is what I want to share with you. And here we're going to show you some dates coming up. These are not the only dates, but these are the main dates. And the first one is on the 6th of August 2021. Now, do you remember when we looked at the seasonality chart, we quite often see lows around the 6th of August. Now, these turning points, or these profit finding oracle points as we call them, are calculated in a completely different way to seasonality. And that suggests that we're going to see a trend around the week ending 6th of August. As I say, seasonality shows lows around there, but if the market happens to be heading up into that point, we could see a reversal. The point is we can expect a change in trend. And I'm just going to jump ahead and point out that we have a daily cycle within that week. And the daily cycle is on the 2nd of August. So actually that's a key date, because as you saw just a moment or two ago, we overlay these things. So we're getting a daily cycle here tying up with the 2nd of August weekly cycle. So that will be a significant point. Also this year, we're seeing a weekly cycle for the week ending 24th of September. And during that week, we have a daily cycle on the 22nd of September. And of course, that then is the equinox point. So as a change of season, you quite often see changes in trend, especially in commodities. So that's another significant point. And moving ahead, the first week of December could well see a turn. As I say, we don't know whether it's going to be a high or low, but we look at the market as we're trading into it, and we look at the commitment of traders data, we look at the seasonality, and we look at the technical position of the chart. And we get clues from all of these things. And the idea is that if we've got a position into this window, we protect it, hedge it, or take the profits. because what happens to a lot of traders is they stay in a position too long. It makes a high, then it starts coming off, and they're not sure when to get out, and they start giving back profits. So this is why this market timing system really helps enhance trading and investing. It also gives you clues then about once the cycles come in, we look for opportunities. Again, we show you how to manage the risk in our trading course, but we wait for the market to prove itself after these turning points to take the reciprocal or opposite position. And just to show how far ahead we can predict, we've got a significant turning point in the 15th week ending 15th of April 2022, so that's several months away. So you can see we can do this. Daily cycle, another strong daily cycle already becoming evident for the 23rd of August. So as I say, this helps us get an edge, helps us get the odds on our side. Nothing's perfect, but it does help us get the odds on our side. So as I say, if you've got your own trading system and you just want to enhance it with timing, that's what we tell you about in the market timing report. We cover the S&P, gold, crude oil, dollar index, euro, and Bitcoin. And if you're interested in grain trading and that sort of stuff, there have been some tremendous moves. We do have separate grain reports as well. So I hope you found this useful, and you can find out more at markettimingreport.com. As I say, we have the monthly newsletter, the Market Timing Report. We also have two courses. We have the trading course for those of you that don't have a system. It's very important to trade with a system. And we also have the Professional Traders platform, which looks at all the seasonality and commitment of traders' data. You can follow us, follow me at Twitter, at Andrew Pancholi. We also have a YouTube channel for the Market Timing Report, where I post videos on what I see is coming up. Please join up, subscribe to that. To say more information at markettimingreport.com, and also you can go to andrewpancholi.com. And if you have any questions or would like to know more, just contact us through our support desk at support@cyclesanalysis.com. So I hope you find this presentation useful. There's some views on what's potentially coming up on gold, and if you think the Market Timing Report is for you, we'd love to have you on board. Thank you.